Welcome back to the deep dive. Today, we're taking you on a really fascinating journey right into the heart of India's booming retail and lifestyle sector.
That's right.
We're talking about a true titan here, Trent Limited. Now, if you've ever wondered what it really takes for a retail giant to, well, not just survive, but absolutely thrive,
Yeah.
dominate even, in a market as dynamic, as diverse, and let's face it, as fast-moving as India, then you are in for a compelling look behind the curtain today. We're going to peel back the layers on Trent's incredible scale, its growth strategy, and really explore what makes it tick.
And our mission for this deep dive is exactly that. We're aiming to extract the most important nuggets of knowledge, the key insights from a very comprehensive, very detailed investment analysis of Trent Limited.
Right.
So we'll be looking at the company through the specific lens of that expert analysis, understanding its strengths, yes, but also the risks it's navigating and the strategic moves it's making to really expand its empire. It's about getting to the core of what drives this retail powerhouse.
Exactly. Think of this as your kind of express shortcut to understanding this complex company. We're aiming to shed light on those surprising facts, those aha moments, and give you enough detail so you feel really well informed, but, not drowned in data.
Yeah, avoid the overwhelm.
We'll dig into what the analysis found particularly noteworthy and crucially why it matters for understanding the whole picture of Trent Limited.
Okay, let's dive in.
So we've hinted at the scale, but let's unpack this. What exactly is Trent Limited? How has this company managed to carve out such a significant, almost unshakable presence in India's retail scene? It's incredibly competitive out there.
It really is. And from the perspective of this investment analysis, Trent Limited operates right at the forefront of that retail and lifestyle segment in India. They manage a diverse and strategically segmented portfolio, brands across fashion, but also food and grocery.
Okay.
The analysis highlights several key formats that are really the backbone of their operations. You've got Westside, that's their flagship fashion and home brand, known for its curated stuff.
Right, I know Westside.
Then there's Zudio. Zudio has just exploded really as a powerhouse in value fashion, very important part of the story.
Okay.
Samoa's newer, focusing on premium ethnic fashion, tapping into that cultural trend. And finally, Star, which covers their food and grocery retail side.
Got it.
Now, to really grasp the scale, the analysis reports some truly remarkable figures. Trent recorded, get this, 17,624 crore in gross sales.
Wow.
That's a 39% year-over-year growth. 39%.
That's huge at that scale.
Exactly. It's not just growth. The analysis calls it hypergrowth, pretty much. They have a physical presence now in 1,043 stores.
Over 1,000 stores.
Spread across 242 cities, and they're serving over 100 million customers a year.
100 million customers.
These numbers, they don't just speak to expansion, they speak to, a colossal reach, a really deep footprint into the Indian consumer market. They're touching a lot of lives.
Wow, those figures are genuinely eye-popping. I mean, 39% year-over-year growth. That's the kind of number most companies only dream of, especially at that size. But the analysis isn't just about the big numbers, is it? It digs into the why. What did the analysis pinpoint as Trent's foundational strengths, in its business model, that let them achieve this kind of performance?
Yeah, it identifies several crucial strengths that really contribute to their strong market position. First off, it points to Trent's integrated operations with end-to-end control.
Okay, what does that mean in practice? End-to-end control.
It means Trent isn't just, buying products off the shelf from suppliers and selling them on. They actually manage everything, from the initial design, the concept, through sourcing, manufacturing, all the way to the final retail experience in their stores.
Okay.
And the real aha moment here, as the analysts highlight, is that this kind of vertical integration gives them, unparalleled efficiency and responsiveness.
Right, speed to market.
Exactly. Think of it like they have a fashion radar and a high-speed production line all rolled into one. They can spot a trend, design it, get it made, and have it on the shelves in Westside or Zudio incredibly fast. Much faster than retailers relying on external suppliers. It streamlines everything.
So they're not just a shop window for other brands. They're creating and selling their own stuff, which must help margins and loyalty, right?
Precisely. That leads straight to the second major strength the analysis emphasizes, their high percentage of own branded products. This isn't just a small detail, it's a massive competitive advantage.
Why is it so key?
Well, When a company sells its own brands, think Westside labels or Zudio's clothes, it captures significantly better margins. Much better than just selling third-party stuff. Because they control the whole value chain, right? Cut out the middleman.
Makes sense.
And beyond just the money, it builds a much stronger brand identity, increases customer stickiness. People associate the shopping trip directly with Trent's unique offerings, not just stuff you can find anywhere. The analysts consistently point to this as a real differentiator.
Okay, so integrated operations, strong own brands. What about where they operate? The analysis mentioned Tier 1 cities, but also Tier 2 and 3. How does that geographic strategy play into their strength?
That's the third key strength identified, their strong presence in both Tier 1 and Tier 23 cities. This dual approach is really smart, strategically speaking.
How so?
Tier 1 cities, your Mumbai, your Delhi, they offer high spending power, brand visibility, they set trends. But the analysis suggests that the real volume growth in India often comes from tapping into the growing consumer base in Tier 2 and 3 cities.
Where modern retail is still emerging.
Exactly, where disposable incomes are rising fast. So this diversification, it spreads the risk. It means they aren't too reliant on any one big city. It also lets them scale rapidly by reaching new customers, new areas that are hungry for organized modern retail. It really underpins those huge expansion numbers we saw.
It sounds like a very well-rounded strategy, covering the big metros, but also pushing into those developing areas. But look, no business, especially at this scale in retail, is without challenges. What did the analysis flag as the main risks for Trent's model? Things investors should be aware of.
Absolutely. The analysis flags a couple of important inherent risks. The first one is just the reality of retail volatility and trend dependence, especially in fashion.
Fashion changes fast.
Like lightning. So there's a constant, significant risk of inventory just becoming obsolete. If a style or color suddenly goes out of fashion, bang, you're stuck with unsold stock.
Which means markdowns hitting profits.
Right. It demands incredibly sharp inventory management, accurate forecasting, quick turnarounds. The second risk, highlighted by the analysts, is Trent's brick-and-mortar heavy model.
All those physical stores.
Yeah. While it gives them that strong presence, that tangible customer experience, it also means continuous substantial investment. We're talking prime real estate costs, big rents, expensive store fit-outs, ongoing upkeep, plus all the staff needed.
So it's capital intensive, much more than online-only players.
Fundamentally, it's a trade-off. That strong physical footprint versus capital efficiency. You need a lot of capital to keep building and maintaining those stores.
That's a great point, especially now with digital-first companies scaling so fast with less capital. So thinking about the listener, when you're out shopping, do you actually notice when brands are own label versus multi-brand? And does it really influence how you feel about a store or your loyalty? For me, sometimes there's a trust, a uniqueness with a good house brand.
Oh, absolutely. And my own experience really lines up with what the analysis suggests about Trent's strategy. When a brand delivers consistently, whether it's value or a certain style or quality, it builds this intangible trust, doesn't it?
Yeah, it does.
The focus on own brands isn't just about margins. It's fundamentally about creating a unique identity that customers literally cannot find anywhere else. That exclusivity is a massive differentiator in a crowded market.
Like Westside stuff or Zudio.
Exactly. It's unique to Trent. It builds a connection, a feeling of sort of curated selection, much harder to do when you're just selling other people's labels. That stickiness translates directly into repeat visits, stronger loyalty. It's like your favorite coffee shop's own blend. You go back for that taste, not just any coffee. That loyalty is incredibly valuable.
That's a perfect analogy. Okay, here's where it gets really interesting, I think. Beyond the stores, the operations, the brands, how healthy are Trent's financials, according to this investment analysis? What do the numbers truly tell us about its efficiency, its pulse?
Right, the financial section. And the analysis presents a very robust, very compelling picture for Trent here. It highlights several key metrics pointing to exceptionally strong performance.
Like what?
Okay, so earnings before interest and taxes, EBIT, grew by a hefty 56% to reach 1,822 crore. Profit before tax, PBT, also saw that same 56% jump, hitting 2,077 crore.
56% growth in profit? That's significant.
It really is, especially considering the broader economy. But maybe one of the most impressive figures, and the analysis really hammers this home, is the operating return on capital employed, or ROCE. It stood at an astounding 37.2%.
37.2% ROCE.
Astounding is the right word. And then their earnings per share, EPS, reached a healthy 44.58, and they delivered a very substantial dividend payout, 500%.
500% dividend.
Yep. So these aren't just good numbers. The analysis suggests this is a business firing on all cylinders financially.
Those numbers definitely paint a strong picture, especially that ROCE. For listeners, that 37.2%, that's frankly exceptional. Can you break down what ROCE really tells us and why that figure, from the analyst's view, signals such efficient use of capital?
Certainly. ROCE, return on capital employed, it's a critical profitability ratio. It basically tells you how well a company is generating profits from all the capital it has invested in its operations.
So money put in versus profit coming out.
Precisely. It shows how much profit the company makes for every rupee of capital employed, whether that's building stores, managing inventory, investing in brands, whatever. A ROCE of 37.2% is, well, incredible because it signifies highly efficient capital use.
Okay.
Think of Trent like a finely tuned machine. For every 100 rupees they put into the business, the analysis shows them generating nearly 37 rupees back in operating profit. That level of return is considered outstanding. It points to strong operational discipline, a highly effective business model, a real sign of financial strength.
And the analysis mentioned strong profit growth, even with inflation, pushing costs up everywhere. What does that specific detail suggest about Trent's products and market position, according to the analysts?
That's a really crucial observation in the analysis. Strong profit growth when inflation is hitting everyone. It suggests a few key things. First, incredibly resilient demand for Trent's products.
People are still buying, even if things cost more generally.
Exactly, which speaks volumes about the perceived value, the quality, the appeal of their brands. Second, it implies Trent has really effective ways to manage its own costs, or perhaps more powerfully, it has strong pricing power. They can pass on some inflation to customers without killing sales volume.
Which is hard to do.
Very. This resilience, this ability to grow profits despite those headwinds, is a very positive sign for investors. The analysis highlights it consistently.
And that 500% dividend payout. What message does that send about management's confidence and their view of the future, based on the analysis?
A 500% dividend payout, as the analysis emphasizes, sends a few strong signals. First, it clearly indicates a shareholder-friendly approach. Management wants to return a substantial chunk of those impressive earnings directly to shareholders.
Okay.
Second, and maybe more importantly, it's seen as a clear sign of management's confidence in the company's ongoing profitability. Their ability to keep generating strong cash flows in the future.
It wouldn't pay it out if they were worried.
Exactly. They wouldn't pay out such a huge dividend if they didn't firmly believe they could keep generating strong earnings while also funding those aggressive expansion plans we talked about. It suggests a confident balance, reinvesting for growth and rewarding current investors. Analysts really look for that balance.
That's a great sign of confidence. But was there any note of caution from the analysis regarding these great financials? Sometimes rapid growth can, introduce new risks or stretch things thin.
Absolutely. You've hit a critical point. The analysis does raise one single but very important caution. The sustainability of ROCE needs monitoring given aggressive expansion plans.
Ah, okay. So can they keep that amazing 37% up?
That's the core concern articulated by the analysts. While 37.2% ROCE is fantastic now, rapid growth requires huge ongoing capital spending. Building all those new stores, entering new markets.
Of money.
A lot of money. The worry is, as Trent keeps expanding so fast, can it ensure that the new capital being deployed continues to generate similarly high returns? Or will the sheer volume of investment dilute that overall capital efficiency, at least for a while?
So growth could potentially lower the average return.
Potentially, if not managed with extreme precision. The analysis presents it as something crucial to actively monitor rather than an immediate red flag. Keep an eye on whether that impressive ROCE holds up as they scale at this pace.
That makes perfect sense. It's about ensuring that health is sustainable as they get bigger. So if you were looking to invest your own money hearing all this, what financial indicator stands out most to you? For me, that ROCE number is just screaming efficiency.
I completely agree. The ROCE is incredibly compelling. It says they're not just making money, they're making money efficiently. But beyond that, for me, the strong profit growth despite inflation really stands out.
The resilience factor.
Yes. It shows a resilient business model, real consumer appeal that can weather economic storms. If a company can boost profits significantly when costs are rising everywhere, that speaks volumes about its pricing power, its operational control, the demand for its products. The analysts' focus on this resilience underlines its importance. That combination, high capital efficiency and resilient profitability, would definitely catch my eye.
Okay, let's shift gears slightly. The analysis repeatedly brings up Trent's aggressive expansion. We've touched on it, but this isn't just slow and steady growth. It's a real push. What concrete steps did they take in FY25 that highlight this? And what does this ambitious strategy signal about where they're headed?
Yeah, the analysis details some truly remarkable expansion efforts in FY25. During that single financial year, Trent added a staggering 295 new stores.
295, wow.
It's not just a few new shops, it's a massive scale-up of their physical footprint. And crucially, this included opening 2 groundbreaking stores in Dubai.
Dubai, so their first international move.
Their very first foray into the international market. Beyond just the store count, they also added over 3 million square feet of new retail space.
3 million square feet? That's enormous.
It is, in a single year. This means their total store count across all their formats now tops 1,000.
Over 1,000 stores.
So this aggressive pace, this sheer volume from the analyst's viewpoint, it signals a clear, assertive push to grab significant market share, to really capitalize on India's growing consumer market and that shift towards organized retail.
2 stores in Dubai. That's a really interesting, bold move internationally. What strengths did the analysis see stemming directly from this aggressive expansion strategy?
Yes, the analysis points to several strengths in this approach. Firstly, the expansion is geographically diversified. It spans the big metros and those rapidly developing smaller towns we discussed.
The Tier 1, 2, 3 strategy again?
Exactly. According to the analysts, this is vital because it broadens their market reach massively. Tapping into high-spending urbanites and the growing aspirational groups in smaller cities. This diversification also makes their revenue more robust, less reliant on any single city's economy.
Makes sense. And the international move?
That entry into the international market in UAE, as you noted, while it's a cautious first step, just 2 stores, it reflects real ambition. It signals the potential scalability of their model beyond India. It's a strategic test. Does the brand appeal work elsewhere? It's a potential path for future global growth, and definitely a point of interest for the analysts.
It sounds like a strategic toe in the water, maybe testing the international appetite. But like any rapid growth, especially at this scale, there are always potential downsides, right? What concerns did the analysis flag about this aggressive expansion?
It definitely did. The analysis highlights some important concerns tied directly to this speed. First is that fast-paced expansion can significantly increase capital expenditure and operational complexity.
More money needed, more things to manage.
Precisely. Opening nearly 300 stores in a year, adding millions of square feet. That requires immense financial investment. Real estate, construction, inventory. It can strain financial resources. And beyond the money, managing over 1,000 stores across diverse locations and formats adds huge layers of operational complexity.
Like logistics, staffing.
Logistics, supply chain staffing, training, maintaining consistent brand standards, customer experience. It's a massive management challenge.
So it's not just finding the cash, it's ensuring the whole system infrastructure people can actually keep up without quality dropping. What about the risk of store saturation? Or cannibalization. You hear those terms a lot in retail.
Exactly. The analysis specifically warns that retail chains must actively avoid store saturation or cannibalization, especially in urban regions. Saturation is when there are just too many stores, yours or competitors, in one small area. It can dilute sales for everyone.
Right.
Cannibalization is even more specific. It's when your new store mostly just steals customers from your existing nearby stores, rather than bringing in genuinely new business.
So you're just shuffling sales around, not really growing the pie.
Exactly. It's a critical risk, especially in dense urban areas. If not managed carefully, you end up with lower sales per square foot, lower overall profitability, even though you have more stores. The analysts stress this as a key strategic thing to watch.
It really is a double-edged sword. Grow, yes, but don't hurt your existing successful spots. When you see a company expanding this fast, what questions immediately jump into your mind as someone looking deep into these analyses?
The first thing I always wonder about is the talent pipeline and management bandwidth. Can the leadership team and the organization actually handle the sudden surge in complexity without things breaking, without customer experience suffering?
Good point.
Second, financial leverage. How are they funding this? Is it responsible, or are they taking on too much debt? The analysis did mention watching cash flow sustainability, which ties right into this. And finally, data. Are they using data effectively? To pick the right new locations, to manage inventory across this huge network, to predict trends and avoid that fashion volatility risk. Rapid, successful growth, in the analyst's view, really needs sophisticated data intelligence to avoid expensive mistakes.
Okay, so what does all this expansion and operational strategy mean for the actual customer experience? Let's turn to Trent's brand portfolio itself. How do Westside, Zudio, Samo, and Star each contribute to their competitive advantage based on the analysis?
Trent's brand portfolio is really seen by the analysis as a masterclass in smart market segmentation. Each brand has a distinct role, targeting a specific customer or need.
Okay.
Westside, for instance, is positioned as their mid-premium fashion and home brand. Its unique selling point, noted keenly by the analysis, is that heavy emphasis on 100% exclusive, in-house designed brands.
So stuff you can only get there.
Exactly. Customers get designs they genuinely can't find elsewhere. It creates a sense of uniqueness, quality, perceived value. It's about a curated experience, not just clothes on a rack.
So exclusivity is key for Westside. And then there's Zudio, which you said has exploded. How is it positioned strategically, according to the analysis?
Zudio is a real standout, and the analysis gives it a lot of attention. It's highlighted as a value fashion brand, aggressive pricing, broad appeal across income groups. What makes Zudio so smart, from the analyst's perspective, is its fast, affordable, and mass market focused model.
Fast fashion, but affordable.
Right. And that approach is key to its rapid scale and market penetration. Offering trendy fashion at very accessible prices brings in a huge customer base, drives massive volumes, allows for quick expansion. It's strategically designed to capture that enormous price-sensitive segment of the Indian market. It's been a massive engine for Trent's growth.
So Zudio is really the volume driver then?
A major one, absolutely. Then you have Samo, the newer player, specifically targeting premium ethnic wear. This shows Trent strategically moving to capture a share of the growing market for, traditional Indian clothes, but at a more upscale level, diversifying their fashion offering.
Okay, and Star, the supermarket.
Star is their supermarket format. And the analysis points out something interesting here. Over 70% of Star's revenue comes from its own private label brands.
So the own brand strategy, again, even in groceries.
Exactly. It echoes the success they've had in fashion, better margins, tighter control over the products, even in the grocery space. It's a consistent theme across the board.
It sounds like a really well-thought-out, targeted portfolio.
Yeah.
What did the analysis say were the overall strengths of this multi-brand strategy for Trent's competitive edge?
The analysis points to several big strengths. First, it emphasizes a strong brand-led strategy with exclusivity and in-house curation. Having distinct brands lets them capture different market segments effectively without watering down any single brand's image. Each one serves a specific need and price point, maximize the reach.
Right.
Second, that exclusivity and in-house curation is just pivotal. It fundamentally differentiates Trent from competitors who might just be selling lots of other brands. Unique products mean a stronger identity, reinforcing that own brand advantage we keep coming back to. Makes them hard to copy.
So they're not just offering variety, they're offering their own unique variety. That gives them a distinct place in the market.
Precisely. And that leads to the third strength: product differentiation and pricing discipline. The analysis consistently notes these help Trent keep healthy margins and build real customer loyalty across the different segments. Westside can command higher prices because it's exclusive perceived quality. Zudio thrives on volume at aggressive, but still profitable, prices.
Smart pricing across the board.
Yes, strategic pricing combined with differentiated products ensures sustained profitability. And finally, the analysis really underlines Zudio's rapid scale model. Its affordability, its mass market appeal, strategically brilliant for driving quick expansion and deep market penetration. It's undeniably a key growth engine.
It sounds like a powerful approach.
Yeah.
But as we know, retail's incredibly competitive, always changing. What risks did the analysis identify for Trent's brands in this tough environment?
The analysis highlights two main ongoing risks. Firstly, retail brands face continuous and intense competition from e-commerce platforms and global retailers. This is a huge challenge for any brick-and-mortar focused player.
Online convenience, global scale.
Exactly. Online offers convenience, often lower prices, massive selection. Global players bring huge scale, deep pockets, international trends that can disrupt local markets fast. Trent has to constantly innovate to make its physical stores compelling enough to compete.
Okay, that's a big one. What else?
Secondly, there's the constant challenge of maintaining brand freshness and continuous innovation. Especially in fashion, tastes change, trends evolve incredibly quickly. This needs nonstop investment in design, product development, marketing, understanding what customers want next.
Keeping things relevant.
Absolutely. Making sure brands like Westside and Zudio stay appealing, resonate with their audience, and don't just become stale or outdated. It's a never-ending race to stay ahead.
It really is a constant race.
Yeah.
On a personal level, do you find you have certain brands you really trust for specific things? And what makes you keep going back? For me, often it's consistency and value, just knowing what I'm going to get.
Absolutely. And my own experience mirrors what the analysis suggests about brand power. When a brand consistently delivers, whether it's Zudio's value or Westside's unique style and quality, it builds enormous trust.
Right.
What keeps me coming back, it's that mix of reliable quality, feeling like they get what I need as a consumer, and that sense of curation, that they offer something special. And honestly, the convenience of a multi-format retailer like Trent helps too. If I can potentially get fashion, home stuff, maybe even groceries, under brands linked to a parent company I trust, it simplifies things, reinforces loyalty. It's the whole ecosystem of trust they build.
Okay, moving beyond the financials and the brands.
Yeah.
What does this analysis tell us about the leadership, the ethical backbone of Trent Limited? How important is good governance in the overall investment picture, especially for an analyst looking at a company like this?
The investment analysis places huge, almost foundational importance on Trent's governance and management quality. It's highlighted as a crucial strength underpinning everything else. A key point made repeatedly is Trent's affiliation with the Tata Group.
Ah, the Tata connection. That's significant in India.
Hugely significant. The Tata Group is renowned globally for exceptionally strong ethics, a deeply ingrained culture focused on all stakeholders, not just shareholders, and a long-term vision prioritizing sustainability and trust.
So it brings instant credibility.
Massive credibility. It assures investors of high corporate integrity, a robust, forward-looking approach. From an analyst's viewpoint, this fundamentally reduces investment risk.
So the Tata name isn't just branding, it's almost like a seal of approval for values and stability. The analysis also mentions specific awards Trent received. What do those signify in a practice, according to the analyst?
Exactly. And the awards are external proof points that back up the positive assessment of their commitment to excellence. The analysis notes several. The Golden Peacock Award for governance.
Okay, governance specific.
Right, directly validating their strong ethical framework and best practices in leadership. Basically, proving they run things transparently and responsibly. Then Zudio was named Best Fashion Retailer. That speaks volumes about its market impact, customer resonance, operational excellence in that key segment.
Right.
They were also named a top value creator by Dun & Bradstreet, showing they consistently generate significant economic value. And finally, a top supply chain champion. This highlights their operational efficiency, their logistics skills, absolutely critical for a company with over 1,000 stores and rapid expansion.
Wow, that covers a lot of ground.
These awards, taken together, are powerful external endorsements of the internal strengths and sound management practices that the analysts observed.
Those are really impressive endorsements across key areas. So how did these factors, a Tata link, the awards, translate into concrete advantages for Trent from the analysis's detailed perspective?
The analysis carefully explains why these are seen as crucial strengths. Firstly, that strong corporate governance culture, rooted in the Tata ethos, ensures credibility and builds significant long-term investor confidence.
People trust them more with their money.
Fundamentally, knowing interests are protected, decisions are transparent, business is ethical, that promotes stability and lowers perceived risk. Secondly, the analysis highlights Trent's proactive and forward-looking management. This isn't just fluff, it's shown by their focus on inclusivity, sustainability, and strong digital adoption.
Why are those specific things so vital now?
Because they signal a management team building a resilient, future-proof business, not just chasing quarterly numbers. Inclusivity and sustainability appeal to modern consumers, meet changing expectations. Digital adoption is crucial to compete, especially against e-commerce. This holistic, ethical, forward-thinking approach, seen as a huge positive in the analysis, a real differentiator.
It's a powerful mix. Strong ethics, proven performance, and an eye on the future. When you think about a company you personally admire, how much does its ethical stance or management style factor into your perception, even if it's not obvious on the balance sheet?
For me, it plays a profoundly critical role. Financials are key, obviously, but ethics and management quality, that's the bedrock upon which sustainable success is built, in my view.
It speaks to resilience.
Exactly. It speaks to long-term resilience, the ability to navigate challenges. A strong ethical framework, like the Tata Association implies, reduces risks, reputational damage, legal issues, internal problems that can cripple even a financially strong company. Plus, proactive, forward-looking management anticipates shifts, invests smartly, cares about employees, environment, things increasingly important to customers and responsible investors. It gives us a deeper confidence they're building enduring value, not just short-term profit.
Okay, so the analysis wraps up with an overall investment view, pulling together all these different threads we've discussed. Let's bring it all together now. How does this expert analysis ultimately rate Trent Limited's attractiveness as an investment after dissecting everything?
The analysis gives a very neat summary evaluation across key parameters, pulling it all together, for its business model. Strong, brand-led, integrated across value chain. That sums up its operational and strategic approach.
Clear positive there.
Financial strength. Evaluated as high ROCE, strong profit growth, high dividend, clearly indicating robust health and shareholder focus.
Another strong positive.
Growth potential. Assessed as significant with aggressive store and format expansion, highlighting that ambitious future path.
Right.
Risk factors. Acknowledges retail volatility, high capex needs, trend dependence, reiterating those inherent challenges, showing balance.
Fair enough.
And finally, valuation comfort, always crucial for investors. Notes it may be expensive at current levels depending on market pricing. A pragmatic caution about the entry price.
Okay, so lots of very strong positives, but balance with the risks and a keynote on valuation. What's the overall takeaway then? A big picture conclusion on Trent's investment view from the analysis.
The overall investment view from this detailed analysis is definitely positive. It concludes Trent Limited is, and I quote, a well-managed, fast-growing retail company with strong brands and operational discipline.
That sums it up nicely.
It really does. It captures the strengths across the model, financials, and management. And crucially, the analysis explicitly states Trent is well-placed to benefit from India's rising consumption and urbanization trends.
Tapping into those big macro shifts.
Exactly. The growing middle class, rising incomes, the ongoing shift from small local shops to modern, organized retail across India. It paints a picture of a company strategically positioned to ride these powerful, long-term demographic and economic waves, poised for sustained success.
That's a very optimistic outlook, especially given the broader context. But for investors, there are always those specific watch-outs, right? The monitoring points. What practical advice does the analysis offer potential investors looking closely at Trent?
Yes, this is where the analysis provides really valuable practical guidance. It lists 3 crucial monitoring points. First, investors should monitor the impact of expansion on margins and returns.
So make sure growth doesn't hurt profitability or that great ROCE.
Precisely. Ensure new stores contribute positively, don't dilute efficiency. That's the question. Aggressive spending consumes cash. Investors need to see if the company generates enough operational cash flow to fund growth organically, without relying too much on debt or external financing, which could create strain. These are the critical checkpoints highlighted by the analyst.
Okay, that's very clear advice. Given everything we've unpacked about Trent Limited, the integrated model, the financial efficiency, aggressive growth, diverse brands, strong governance, what's your gut feeling? What parts of its strategy seem most solid, most enduring, and which aspects would you personally keep a really close eye on?
My gut feeling is Trent Limited is a really compelling case study. How to succeed significantly, sustainably in a dynamic market like India. The most robust parts, definitely the commitment to own brands that gives them margin control, unique identity, and the smart multi-brand approach, especially Zudio's scale and affordability model, that captures a huge market, drives growth. That combination feels like a strong competitive moat.
Hard to replicate.
Very. And the Tata governance provides that bedrock of trust and long-term vision. What would I watch closely? Definitely the sustainability of that super high ROCE as expansion continues. Can they maintain efficiency at scale?
Right, the growth versus efficiency balance.
Exactly. I'd also watch the international move into Dubai closely. Is it a sign of future global potential? And of course, that ongoing battle with e-commerce and the need for constant brand innovation. Can they keep things fresh enough to fend off digital rivals? Those are the key things I'd monitor.
What an incredible journey today unpacking the Trent Limited story. From integrated operations and powerhouse brands like Westside, Zudio, to that impressive financial performance, the aggressive expansion. It's a real testament to strategic agility in India's retail sector. We've seen that fascinating mix of a solid business model, financial discipline, ambition, and that strong governance analysts value so much.
Indeed. Trent's story, as this analysis shows, really offers a lesson not just in retail, but maybe in broader business strategy. Growth is exciting, yes, but it always needs that careful balance, seizing opportunity while managing risk. It shows how critical things like ethical leadership, forward-thinking management are for long-term sustainable success, especially amidst change and competition.
Yeah.
Their journey reflects that wider story of India's economic dynamism, that rising consumer power. And it leaves you thinking, doesn't it? In this era of fast tech changes, shifting consumer habits, what really defines the future of successful retail? Is it just more stores, or is it that seamless blend of digital innovation, amazing customer experience, and solid ethical practice?
That is definitely food for thought. Thank you so much for joining us on this deep dive today. We really hope these insights act as a springboard for your own curiosity, your own understanding.
Hope so too.
The world of business and finance is always, always ripe for deeper exploration. So we encourage you, keep asking those big questions. Until next time, keep learning, keep growing, and keep diving deep.